Good afternoon, and thank you for joining the National Conference of State Legislatures and the Pew Charitable Trust for this briefing on payday lending. My name is Heather Morton, and I am a program principal in the Fiscal Affairs Department of the National Conference of State Legislatures. I cover the issues of banking, insurance, and other financial services, and I am moderating today's webinar, Payday Lending in the States. The National Conference of State Legislatures is pleased to partner with the Pew Charitable Trust to bring this webinar to you. This jointly sponsored webinar will examine payday loan borrower motivations and demographics, as well as how state regulation affects payday loan usage, and will feature the findings from a report by the Pew Charitable Trust State Small Dollar Loans Research Project. In case you are not familiar with NCSL, we are a bipartisan organization that serves the legislators and staff of the nation's 50 states, its commonwealths, and territories. NCSL provides research, testimony, and opportunities for policymakers to exchange ideas on the most pressing state issues. NCSL conducts a number of activities related to payday lending. For example, I publish annual summaries of state payday lending legislation, statutes, and other resources, and make the information available through NCSL's website and through testimony to legislative committees. In addition, payday lending issues are within the jurisdiction of the NCSL Standing Committee on Communications, Financial Services, and Interstate Commerce, also known as the Cfi Committee. NCSL Standing Committees allow legislators and legislative staff to exchange state experiences in shaping public policy and managing the legislative institution. The Cfi Committee will next meet in person at NCSL's Fall Forum in Washington, D.C., December 5th through the 7th. For more information on the Fall Forum or NCSL's activities and services to legislators and legislative staff, please visit our website at www.ncsl.org. We live in an ever-increasingly complex world with many different options for getting financial assistance and loans. Payday or deferred presentment loans are small dollar credit products that are secured by a claim to the borrower's bank account with a post-dated check or electronic debit authorization and are due in full on the borrower's next payday. The majority of states regulate payday loans. In recent years, state legislatures have been reviewing their payday lending statutes in response to concerns regarding consumer protection and changes in the lending industry. We will hear from our 4 distinguished speakers, and then we will open up the discussion to include questions from the audience. After the presentations, the speakers will be available to answer your questions. To ask questions, you can simply type a question in the Q&A box in the right-hand corner of your screen. We will take as many questions as possible within the time frame we have available. Our first speaker, Nick Bork, is the director of the Pew Safe Small Dollar Loans Research Project, which conducts research on consumer needs and perceptions, market practices, and potential regulations of payday and other small dollar loan providers. The project also offers policy recommendations designed to protect consumers from harmful practices and promote safe, transparent credit. Mr. Bork holds a bachelor's degree in Science, Technology, and Society from Stanford University, and his law degree is from the University of California at Davis. He is a member of the State Bar of California. Welcome, Mr. Bork.
Great, thank you. I'm really pleased to be part of this. Thanks so much for co-hosting it with us, and thanks everybody for participating. So I'm just going to get right to it. And first, a brief note about Pew. If you're not familiar with Pew, we're a 501c3 nonprofit organization. We have a lot of different research interests. The part of the Pew world that we fall into is our consumer financial security work. We have a number of different projects, and you can see some of those on the screen. But where I'm coming from today is the Pew Safe Small Dollar Loans Research Project. And you can find the report that I'm going to be talking about today, as well as various other research items, on our website at pewtrust.org/small-loans. Real quickly about how payday loans work, since I'm the first presenter. The borrower will have an income source and a checking account or depository account, usually a checking account. They will write a post-dated check or give authorization electronically to their checking account as a security for the loan. The entire loan is due back on the next payday, which is typically 2 weeks later. And if the borrower cannot repay that entire loan in the lump sum all at once, they often have the option of either renewing the loan or paying it off and then reborrowing before their next payday. We find that the average loan size is $375, and the average fee for a storefront loan is $55 for every 2 weeks. A little higher for online loans. I'll talk about that later. The research that I'm going to present today is based on a first-of-its-kind nationally representative survey of payday loan borrowers. We did this through random digit dial methodology, so it's a random sample of the entire country, and we found people who have used payday loans using various techniques. It's a two-part survey. The omnibus survey is based on nearly 50,000 screening interviews, and this is the part of the survey that we'll base all of our demographic information on and information about usage rates, how often people use the loans and so on. Altogether, we used the first about 33,000 and change of those interviews. Margin of error on that sample is 0.2 percentage points. We also have some in-depth questions and about a 20-minute long survey of borrowers. So again, this is nationally representative borrower survey. I'm going to talk about a few of those questions today related to, for example, why did you get a payday loan? That's based on a sample of 451 borrowers nationwide from all different types of storefront lenders. We also did 10 two-hour focus groups across the country before we did the survey, which helped to elaborate why people are using the loans and helped us to construct our survey. I'm going to focus on fundamentals today. There are a lot of questions regarding payday lending. My role today is to focus on the fundamentals. Who uses the loans? Why do borrowers use the loans? What would borrowers do without payday loans? And what have been some of the effects of regulations in this area? One, who uses payday loans? Well, in terms of numbers, we find that 12 million Americans use payday loans annually. What do they look like? Well, that's 5.5% of adults in the past 5 years. The average borrower is in payday loan debt for 5 months during the year. I should mention this information now that I'm talking about average usage is based largely on state regulatory reports as well as industry public filings. So the average borrower is in debt for 5 months during the year. Will spend $520 on payday loan finance charges. And most borrowers are frequent borrowers. So 4 out of 5 borrowers will use 3 or more loans per year. And that accounts for 97% of all loan volume. And 3/4 of loans are renewals or repeat or renewal borrowing within one pay period. Demographically, our report includes a rich vein of demographic data, and we sliced it in several ways. I'm going to highlight a couple of them. If you're interested in payday loan demographics, I'd encourage you to check out our report online. But here you can see, the 5.5% number, which is a little small on your screen. I apologize, but you can see that in the past 5 years, 5.5% of the U.S. population has used a payday loan. In the age category, what that is showing you, for example, is that among all adults aged 25 to 29, 9% of them have used a payday loan. Among all renters in this country, 10% of them have used a payday loan. Our report also includes in its appendix a table, a snapshot of demographics for payday loan borrowers generally. So you can see, for example, that 58% of all payday loan borrowers are renters versus 41% who are homeowners. You can see that 55% of all payday loan borrowers are whites, 23% are African American. We did a logistic regression analysis, and we were looking at odds of borrowing, and we saw that various groups have much higher odds of borrowing, including 103% higher for those who are separated or divorced, or 105% higher for those who are African American. We broke the usage data out geographically. I'm going to brush through this pretty quickly. One thing to note is that in the urban areas, it's the highest level of usage with 7% of people in urban areas. Excuse me. But exurban and rural areas are close behind, with a usage rate at 6% of the adult population. Why do people use payday loans? Well, they're using them to cover ordinary living expenses over the course of months, not unexpected or emergency expenses over the course of weeks. When we ask people, when you got your first payday loan, what did you use the money for? You can see here that 7 out of 10 borrowers use the loans for recurring living expenses. This is things like utility bills, car payments to pay off a loan on a car, rent, mortgage, food. Only 1 in 6 borrowers is using the loan for an unexpected emergency. I want to pause now and talk about packaging versus experience. And this is one big question that we have as we're doing our research. If you look at the packaging or the structure of a payday loan, it's structured as a short-term loan, and it's talked about as that. Talked about as something that we use to cover small or often unexpected expenses, designed to solve temporary cash flow problems and not intended for long-term use. However, the data that I was just talking about shows that the vast majority of people are using the loans for recurring living expenses, and they're actually in debt for quite a long time compared to that 2-week time frame. That's a question that needs to be considered a little bit more here. I want to move on. Number 3, what would borrowers do without payday loans? We asked borrowers, and these are all payday loan borrowers, if short-term loans didn't exist but you had a cash need, which of these options would you take advantage of? And the interesting thing here is that the majority of all payday loan borrowers point to options that don't really connect them to a formal lending institution. And perhaps not surprisingly, 81% of them say, well, I would cut back on my expenses. I would change my budgeting. 62% say they would delay paying some bills. 57% say they might borrow from friends or family. Now, a couple interesting observations about this. One, these options are the same types of options that people talk about using when payday loans are, in fact, no longer available. We talked to borrowers in New Hampshire when we were doing our focus groups. New Hampshire used to have payday loan stores. They don't anymore. And people indicated that this is what they're doing now. They're not going online. They're not looking at other credit options so much. They're doing these options. Also, these are the types of options that people often talk about when you ask them, how did you finally pay off your loan? If a borrower has been using a loan for 3, 4, 5 months, and we say, how did you finally get out of it? Many of them tell us these are the options that they use. So they may have avoided going to family or friends in the first place by taking out a payday loan. They may have gone to family or friends later on in order to get out of it. One final point there, when we're considering options, we need to consider non-credit options as well as credit options. People who are looking at using a payday loan are evaluating a wide spectrum of options, not just shopping for credit. 4, and this may be perhaps our most kind of interesting finding, we were really curious about the impact of regulation. And, a number of states have effectively eliminated storefront payday lending. We found that in states that enact these types of legal restrictions, where payday loan stores are not available, the result is a large net decrease in payday loan usage. Borrowers are not being driven online or to other sources to seek payday loans. So what does that look like? First of all, about 3/4 of payday loan borrowers exclusively use storefronts to get their loans. Only about 16% go exclusively online, and there's very little overlap. Only about 4% of borrowers are using both. When we looked at the usage rates, we characterize the states into 3 categories. Permissive states are states that have payday loan stores with basically free reign, 391% APR and up. Restrictive states are states that don't have payday loan stores through various policy mechanisms. And hybrid states are stores where payday loan stores are available, but there may be some additional restrictions, like a maximum of 8 loans per year, as Washington has, or a maximum of $10 per 100 fee, as Florida has. What we see here is that online borrowing, this column on the right, is occurring at the same level in all of the states, regardless of the underlying storefront policy. Storefront borrowing is way down, obviously enough, I think, in the states where storefronts aren't available. So overall, the level of borrowing is far lower. One additional thing I'll point out here, hybrid states, those restrictions on renewals and restrictions on fees don't necessarily seem to impact usage, so people are using the loans just about as much, but they're paying a lot less generally, I guess would be the import. So what we find then is that in states that restrict storefront lending, 95 out of 100 would-be borrowers elect not to use payday loans at all, and just 5 borrow online loans. And I think I'm about out of time, but one thing I want to mention, you can find more information on our website, and especially if you're interested in state-level usage. So you can see here Oklahoma has a usage rate of 13%. That happens to be the highest in the country. There's also a little bit of information available about complaints about payday lending. We found that complaints are increasing about payday lending, but they're going up everywhere. And in fact, the level of complaints on a per capita basis is identical in every state across the country, regardless of whether storefronts are there or not. And with that, I will hand it off. Thank you.
Thank you, Mr. Bork. Our second speaker is Ronald Mann, and he is the Albert E. Sinelli Enterprise Professor of Law and co-director of the Charles E. Gerber Program in Transactional Studies at Columbia Law School in New York. Professor Mann joined the Columbia faculty on July 1st, 2007, and is a nationally renowned scholar in the areas of secured credit, payment systems, and intellectual property. He is a member of the American Law Institute, a conferee of the National Bankruptcy Conference, and a frequent visiting scholar at Federal Reserve Bank. Welcome, Professor Mann.
Thanks so much. I'm really glad that y'all asked me to come and do this. I've always thought that the state regulations on payday lending are very important in setting the tone for how this product is used. And as Nicholas pointed out in his report documents, the product is used very differently in different states, and the types of regulatory schemes the states use have a lot to say about that. So I'm going to talk more generally about payday lending and how it's gotten where we are, and sort of underscore a few things that I think are still very hard to understand. And the first thing is obvious to most of the people talking today, but perhaps less obvious to some of the audience, which is this is a pretty new product as things go. Essentially, this product was more or less invented in the late 1990s, and from a product that didn't exist when I got out of school, there's now, as Nicholas says, more than 10 million users a year. It's readily available in storefronts in about 2/3 of the states, so there's something like 20,000 storefronts nationwide. And in the states where there are storefronts, it's generally validated by a specific and narrowly crafted exception to the usury laws, so that under state law in those states it's permissible. There was a time in the last decade when states could not prevent out-of-state payday lenders from coming in under shelter of the National Bank Act, but now pretty much any place you have a storefront, it's because there's a user exception that makes it legal. I think the way to think about the product is there's 3 different groups of people that lend into this market, and I think for policy purposes they're very different. One is a group of large publicly traded chains like Advance America or dollar stores. These people are publicly traded companies. They are disciplined by stock markets to try and make money. They're disciplined by reputation not to get in visible trouble with regulators. And they're disciplined by liquidity that if large fines are imposed on them for violating state laws, they'll actually have to pay them. There's a sort of hard-to-gauge number of local mom-and-pop stores that are run by local people in the community. You would think, well, these are closer to customers, probably nice, more benign lenders, but they're, for the purposes of state policy, they're much harder to find and control and regulate because they tend to be not liquid and not stable. The third group, which I think is the hardest to find, is the Internet lenders. There's a lot of websites for Internet payday lending. The prices there range a lot. Some of them are cheaper than storefronts. A lot of them are higher than storefronts. It's very difficult to tell what the actual prices charged are. And for the purpose of state laws, it's as a practical matter impossible for states to exclude them. And so they are really immune from state regulation currently as a practical matter, which makes them troubling if we think that they're being used very often. So customers like this product. They use a lot, but there's a variety of policy concerns people have identified. The most obvious one is the interest rates. So Nicholas describes a fixed fee of something like 15 to 18% per $100. Well, that works out if the loan is 2 weeks to something in the range of 400% per annum. And so if you compare that to a credit card, that's a really high rate. It's probably lower than the imputed interest rate for an overdraft or a pawn shop, but it's higher than a lot of loans for other mainstream credit products. And this has led to a variety of things. For example, at the federal level, there was a statute a few years ago called the Talent-Nelson Amendment that imposed a 36% cap, which essentially means there can be no more payday lending for military families. Another problem, and Nicholas also alluded to this one, is the idea of repetitive or frequent borrowing. And obviously, a lot of customers borrow repetitively. It's not that hard to understand when you look at the nature of the product. If someone's borrowing 35 or 50% of their paycheck on February 15th, how are they possibly going to save back that amount of their paycheck in one pay period so they won't need money in the next pay period? You would expect they wouldn't be able to pay it back very often. It turns out that frequently they can't. The third one, which is a little more elusive, but I think is implicit, if not explicit, in the Pew report, is the idea that there's something deceptive about the product because of this misalignment between frequent borrowing, repetitive borrowing, and this notion that this is a short-term lending product, and I'll say more about that later. So then there's the ultimate question for me. I'm an academic who studies this, is really, is this a good thing or a bad thing? Should we be glad that people are getting these loans, or should it bother us? And that's essentially a very, very difficult question, and all of the study that academics and business people and think tanks like the Pew Institute have done, I think, shed some but not a lot of light on that. And I'll say just a little bit about that as I watch my time run out. The empirical evidence is very hard to come by, because what you want to know is, well, what would happen to these people if they didn't borrow money? And it's just hard to run an experiment and find that out. What we do know is that they have relatively few other options for borrowing money, and so if they don't get money, and they need the money really badly, they may suffer something catastrophic in the range of financial distress. They could file for bankruptcy relatively quickly. We just don't know. Another thing that's relevant to this is that the way that the underwriting works, it's not like a credit card where they can end up borrowing $10, $20, $50, $100,000. We see in bankruptcy lots of credit card borrowers with $100,000 debts. The payday lending is relatively unlikely to get beyond the amount of the paycheck, because that's how it's underwritten. How rollovers affect us, which I think is really the question that Nicholas' study is addressing, is very hard to say. If you were going to cut people off after just one loan, that doesn't have a very different effect from cutting them off from the product entirely. And so it's not a surprise we have lots of rollovers. I think it's really inherent in the product that people are going to borrow frequently. One thing that makes it also difficult in assessing this is it's so different from household to household, and I think it's very clear if you look at data about this that there's some people that are using the product constructively, and there's other people that are using it in ways that suggest they haven't really thought far ahead into the future as to where their finances are going. The last thing I'd like to talk about is a study I've participated in recently, which I'm still working on, and some preliminary results. And I've surveyed about 1,300 payday customers, administered this in stores through groups of about 6 states. And so, although I have many fewer customers than the Pew report, which talks to a large number of borrowers, it's represented nationwide, and my sample is not represented nationwide. It's from 6 particular states. I do have a lot more payday lending customers than the Pew study. And what I did is I tried to match the people's expectations of their borrowing behavior to the actual patterns. And so I asked people on the days that they were going to borrow money how long they thought it would take to pay it back, how many times they would roll it over. And then I waited 6 months so that I could look at the records of their actual loans and see what happened. And it turned out that it suggests the customers really know quite a bit about what's going to happen. Most of them expect that they're going to continue borrowing after the first pay period. The mean is about 36 days, or maybe 2 extra pay periods past the first pay period. And another thing I would say is their predictions are really surprisingly accurate. If you ask them what's the date on which you're going to get clear of debt and not borrow for another pay period, about 60% will get that right within one pay period. So some people will guess wrong. A lot of people will guess wrong. But more than half the people seem to have a pretty good understanding of how they're going to use a product. And I think that plays into the concern about whether or not you want to regulate. Just because of the repeat borrowing, you have to figure out what share of people who don't understand what they're doing is enough to justify making this much harder than it is now. And I'll stop there.
All right. Thank you, Professor Mann. Our third speaker, Diane Standard, is a legislative counsel at the Center for Responsible Lending, a not-for-profit, nonpartisan research and policy organization dedicated to protecting homeownership and family wealth by working to eliminate abusive financial practices. Diane focuses on state-level legislative and policy issues relating to consumer and mortgage lending. She received her law degree from UNC Chapel Hill in 2006, where she was a recipient of the Chancellor's Scholarship and the Law School's Highest Merit Scholarship. Welcome, Ms. Standard.
Great. Thank you, Heather. We really appreciate NCSL hosting this webinar and for inviting CRL's participation. Today, I will cover 3 main points. Number 1, by their very design, payday loans create a long-term cycle of debt. Number 2, reforms that do not address the cycle of debt are ineffective. Number 3, the trend at the state level has been to curb 400% APR payday loans, largely due to broad public opposition to these high-rate abusive loans. I will discuss these points through a combination of empirical research, policy trends, and examples of media coverage stemming from state legislative debates. To begin, I'd like to share an excerpt from an op-ed by retired Lieutenant General Ricardo Sanchez that appeared in San Antonio last month. He says, "Throughout my military career, I witnessed firsthand the destructive effect of these types of loans on the economic welfare of servicemen and women. Today, many of our troops return to cities like San Antonio after multiple combat deployments to Iraq and Afghanistan only to face huge financial pressures. Too many succumb to the quick cash and the persistent hard sell from payday and auto title lenders. The abuse must stop. We owe it to all of our citizens to fight payday and auto title lending abuses here at home." The destructive effect to which the Lieutenant General refers is due to the design of the payday loan itself that leads to the cycle of debt, the high fees, the quick due date of a borrower's next payday, secured by a borrower's bank account, and the lump sum balloon payment. For a typical borrower, this is how the cycle of debt begins and repeats. As explained, they receive their payday loan, it comes due on payday, and one lump payment, which means that as a result of the loan structure and the fact that the payday borrower is already living paycheck to paycheck, they both cannot repay the loan and meet their remaining expenses, and so then must immediately reborrow. This cycle is the norm, not the exception, and it is the core of the business model. Based on payday loan transaction data collected via state-regulated real-time databases, over 76% of payday loan volume is due to this churn. That is, 76% of payday loan volume is due to borrowers taking out a new loan within 2 weeks of paying off their old loan. This is phantom demand. Conversely, only 2% of loans go to borrowers who take out only one loan a year. The typical borrower experience is a long-term cycle of debt. Again, data collected about payday loan transactions from state regulators reveal that the typical borrower is indebted for more than 200 days in a single 12-month period, as shown here in the blue shaded area. This is more than twice the maximum limit recommended by the FDIC, which is 90 days in a 12-month period. Importantly, as I will discuss shortly, this data comes from a state with ineffective reforms, such as rollover bans, cooling off periods, and extended repayment plans that do not stop the debt trap. Beyond the long-term indebtedness and the loss of money paid in predatory fees, academic studies show that use of payday loans increase borrowers' likelihood to experience other long-term financial consequences, such as increased likelihood to incur overdraft charges and bounce check fees, lose their bank account, default on their credit card, and ultimately file bankruptcy. These points of the payday loan business model, being one that exploits individual financial stress and leads to long-term worse financial conditions, is often painted quite clearly in the press. Here is just one example out of Virginia in 2007. As states have grappled with this cycle of debt created by 400% APR loans, some have attempted reforms that do not mitigate the harm. The reason is that these reforms, shown here on the right, do not address the core predatory terms of the product, shown here on the left, that are otherwise codified in state law. States with these provisions, some have the worst debt trap statistics. Data from these states, as shown on the previous slide, show that 76% of payday loan volume is due to borrower churn. The typical borrower is indebted for more than 200 days in the first year of borrowing. In 2006, the U.S. Department of Defense took a hard look at the impact of payday loans on active duty soldiers. The department looked at states that allowed 300% APR loans, along with provisions like databases, loan size limits, roller bans, cooling-off periods, and found, quote, even with the addition of all of these consumer bells and whistles, these laws do not stop the debt trap. As a result of its findings, the Department of Defense recommended and President Bush enacted a 36% APR limit and banned using access to a soldier's bank account as security for the loan. It enacted a 36% rate limit because it found that other reforms, such as databases, cooling-off periods, and the like, were ineffective at mitigating the harms of the payday loan product, which was, quote, undermining military readiness. Since the enactment of this rate cap, the Navy Marine Corps Relief Society reports saving hundreds of thousands of dollars in money previously used to rescue soldiers from abusive payday loan debt. Importantly for state legislators is that these federal protections do not reach veterans or reservists in your state, as these groups are still exposed to the harms of 400% APR payday loan debt to the extent they are allowed by state law. And in many states, military veterans are some of the most active opponents to laws that allow these high-cost products. Since 2005, the state-level trend has been to move in the same direction as the military, to protect all of their citizens by curbing 400% APR payday loans. Since 2005, no state has affirmatively passed legislation authorizing payday loans. And since that time, a number of states that used to allow them now do not. Today, 17 states plus the District of Columbia prohibit 400% APR payday loans, collectively saving their citizens nearly $2 billion a year. Other states have taken some new approaches, such as Colorado, which recently enacted a 6-month minimum loan term for payday loans. Washington enacted a law in 2010 to ensure a borrower is not trapped in more than 8 loans in a 12-month period. In Delaware, just this session, with overwhelming bipartisan support, the General Assembly enacted provisions to ensure borrowers are not trapped in more than 5 loans in a 12-month period. These 2 state laws are modeled after the FDIC suitability standard, which, as mentioned earlier, states that more than 6 loans in a 12-month period is inappropriate. Early data out of Washington and Colorado appear to show that even though payday lenders still operate in the state, the debt trap has been reduced and that residents have saved hundreds of millions of dollars in money otherwise paid in predatory loan charges. This trend toward ending abusive 400% payday loans is consistent with public sentiment. Voters in Arizona, Ohio, and Montana in recent years rejected 400% APR payday loans via ballot initiatives by 2-to-1 margins. Polls consistently show strong bipartisan opposition to these high-cost products, and voters are more likely to support legislators who also oppose them. And diverse stakeholders agree that 400% payday loans are a bad idea and are actively working to stop the debt trap. And it's not just voters who are glad to see these abuses go. Borrowers are too. In a survey of low-income clients of social service agencies in Kentucky, 85% of payday borrowers report that they would not recommend taking out a payday loan to another person in their situation, and the majority reported that the payday loan had hurt them rather than helped. A study by the Commissioner of Banks in North Carolina, where 400% interest rate loans were once legal but now are not, found that 75% of low to middle income families were unaffected by the departure of these high-cost loans. And former payday borrowers reported to be glad of the absence of a product that looked easy to get into but, quote, was hard to get out of. In states with strong consumer protections in place, such as uniform small dollar rate caps, they are well positioned to enforce their laws, regardless of the loans are made online or otherwise. Examples of strong state enforcement actions include those from Arkansas, Pennsylvania, Maryland, West Virginia, Georgia, and others who are keeping predatory lenders from violating their state laws and protecting consumers from falling into the payday loan debt trap. In the words of Georgia Attorney General Sam Olens, quote, "When it comes to payday lending in Georgia, there is no gray area. It is unquestionably illegal in any form. We will not stand for unscrupulous out-of-state lenders taking advantage taking advantage of Georgia consumers. Enforcement actions have been brought against members of the Payday Lenders National Trade Association who claim that abiding by state law is one of their best practices. Legalizing payday loans into state law eliminates the state's ability to protect against the debt trap because the debt trap gets written into the state law. Strong state laws are also important in keeping big banks from offering payday loans directly. 4 national banks are offering bank payday loans under the name of direct deposit advances, which on average carry a 365% APR and result in 165 days of indebtedness. States with strong state laws are deploying these as a tool to keep banks from further expansion into this predatory arena. In a recent letter, the North Carolina Black Legislative Caucus slammed banks for such loans and defended the existing North Carolina state law. A current threat to states' ability to enact and enforce their own consumer protection laws is HB 6139. This bill is being pushed heavily by internet lenders through the Online Lenders Alliance and Cash America. This will essentially create federal charters for non-depository financial institutions like payday lenders and move oversight to the OCC. It will move oversight from the CFPB to the OCC, and it will preempt state laws. The bill is already facing strong opposition from consumer advocates and civil rights organizations such as NCLR, the National Council of La Raza, and importantly, it is also facing opposition from the proposed regulator, the OCC, which in the congressional testimony in opposition stated that they are based on a business model that is not sustainable from the perspective of low and moderate income consumers. They have high fees, high defaults, and severely weak compliance. Importantly for state legislators is that 41 state attorney generals issued a letter of opposition to the bill, noting, quote, that the bill would eliminate crucial consumer protections in many states and curtail our authority to enforce state laws governing the conduct of financial services companies operating within our borders. To conclude, payday loans by their very design create a long-term cycle of debt. Data and borrower experience show that long-term repetitive debt is the typical borrower experience and the core of the payday business model. 76% of payday loan volume is due to churn, and the typical borrower is indebted for a significant portion of the year. Reforms that do not address the cycle of debt are ineffective. Constituents in your state are best served by following the lead of the military to prohibit 400% APR payday loans for all of your citizens, including military veterans, seniors, women, and others. To the voters, the issue is clear. 400% is too high, and legislators who support such high rates face high levels of public scrutiny. As shown here, for example, in a recap of a committee hearing in Pennsylvania last month on a failed bill that attempted to bring 300% APR payday loans to Pennsylvania. Payday loans don't solve the financial crisis. They create a new one every 2 weeks. Thank you for your time.
Thank you, Ms. Sanders. Our final speaker, Jamie Fulmer, is Senior Vice President of Public Affairs for Advance America, the leading provider of consumer financial services in the United States. Advance America operates approximately 2,400 locations in 29 states. He works closely with the Community Financial Services Association of America, the Payday Advance Industries Trade Association, of which Advance America is a founding member. He is a graduate of Wofford College in Spartanburg, South Carolina, a Liberty Fellow, and a member of the Aspen Global Leaders Network. Welcome, Mr. Fulmer.
Thank you very much, Heather, and thanks to all of you on the call today. I'd also like to thank NCSL for organizing and moderating today's webinar, as well as the Pew Charitable Trust for its sponsorship. I'd also like to thank our fellow presenters, Nick, Diane, and Professor Mann. It's important that we get your contributions to an important discussion about payday lending, consumer access to credit, and effective state regulation. I'll apologize up front. I didn't bring any cute cartoons as part of my presentation. But I would like to talk a little bit about our business, Advance America, which operates in 29 states and has approximately 2,400 centers around the country. Today, I'm representing the Community Financial Services Association of America, the CFSA, which is an organization of lenders that abide by a set of consumer safeguards and operational best practices that seek to ensure confidence in the payday lending industry. Today, short-term credit market is served by a number of different providers, both banks and non-banks alike. Consumers use all of these products in a strikingly similar manner, and they access them for the same reasons. They need something to tide them over until their next paycheck, to help them manage urgent or periodic financial challenges. As such, these products are used by consumers interchangeably to meet the same small-dollar, short-term financial needs. I appreciate the perspectives of my fellow presenters and the many contributions that they and their respective organizations have made to help foster a broader and more comprehensive discussion of consumer credit in this country. We also welcome opportunities like today's webinar to describe our services, to clarify misperceptions about our customers, their rationale for using payday loans, and hopefully to move past some of the rhetoric that has come to define the discourse. 15 years ago, the payday lending industry emerged because of consumers' need and demand for affordable small-dollar credit, credit that wasn't readily available to many consumers or offered by many traditional financial institutions. And today, as was the case in 1997, millions of Americans have real need for access to short-term credit. The Payday Loan, Advance America's primary service, is a small-dollar unsecured loan designed to help borrowers overcome a financial shortfall between paychecks. It's a bridge service intended for short-term, periodic use, whether it's weeks or months, not years. The short-term credit landscape has evolved over the years as exemplified by the popularity and rising costs of overdraft programs, as well as the recent growth of bank deposit advances and startup companies now entering the space. Regrettably, credit access continues to remain a challenge for millions of Americans. Too often, this leaves them with limited options to help meet financial obligations and overcome the periodic financial challenges that are an unfortunate byproduct of a still recovering U.S. economy. For example, the Consumer Federation of America states that nearly 40% of Americans live paycheck to paycheck. A 2011 study from the National Bureau of Economic Research found that almost half of American households reported that they would not be able to come up with $2,000 in 30 days if they faced an unexpected expense. Interestingly, the findings were not unique to low-income populations. Roughly 38% of households with an annual income of over $100,000 said they would not be able to cope with such an expense. So who borrows from Advance America? It's worth noting that here on slide 6, that our customer demographics, assembled from an annual survey of more than 385,000 of our almost 1.5 million customers within the last year, are a little different from Q's findings. Advance America's customers average around 42 years of age and has an income of more than $54,000. 94% of our customers have a high school degree or higher, and nearly half own their own homes. The typical Advance America loan is around $375 plus the $56.25 in fees, or about $15 per $100 borrowed, and customers borrow an average of 8 loans during a calendar year. For context, the user of bounce check protection products typically do so between 12 and 13 times a year. So why do customers borrow from Advance America? During a time when income levels have stagnated, many are still struggling to save. For many, cutting back on expenses or borrowing from friends or family is not always the solution. When faced with financial difficulties, many consumers look for a reliable and competitively priced credit solution to manage their financial obligations in the short term. They tell us that they use our service for a variety of reasons, whether it's to pay their rent or utilities, make a car payment, avoid bouncing a check, or dealing with a medical emergency. Of course, before choosing any lender, consumers should carefully weigh their options, including bank and credit union advances, overdraft fees, and borrowing from a retail lender such as Advance America. They should also consider the consequences and costs of missed or delayed payments, such as late fees to vendors and other penalties. To help inform consumers' choices, Advance America discloses its one-time flat fee, around $15 per hundred as I mentioned, as both a dollar amount and an implied annual percentage rate, around 390%. According to several studies in our own experience, however, consumers typically make their credit decisions based on the actual cost, the $15 fee, compared to the cost of their alternative. Still, we disclose the APR in order to help them compare products and make smart borrowing decisions. And of course, our loans do not accrue interest. Whether a customer repays their loan in 3 days or 30 days, they pay the same fee. Compared to other options, many consumers see the payday loan as making personal and economic sense. It may actually be their least expensive option. In addition, there's no impact on a customer's credit rating, no revolving debt or collateral, and it's a dignified and trusted service. For example, studies from Pew, Moog Services, and the Consumer Federation of America have reported the rising cost of overdraft fees, which are approaching $30 per overdraft. The APR for these fees can stretch to well over 3,000%. Our employees fully disclose and carefully walk each customer through the terms and fees associated with their loan. Our terms are straightforward because we want to help our customers be successful borrowers. In fact, our business depends on it. But make no mistake about it, as with any credit product, there are inherent risks. And to help consumers, we provide them with a number of important consumer protections designed to make their decisions informed and fully associated with the products and services that we receive so that they are used responsibly. These protections form the industry best practices required of all CFSA members and include the disclosure of our terms and fees, truthful advertising, no criminal prosecution, fair debt collection practices, and a cap on the number of loan renewals. Importantly, we also offer an extended payment plan at no additional cost with no accruing interest or impact on their credit rating. This is an important safety valve that is completely unique in the financial services world. In fact, I know of no other product that allows borrowers to modify the terms of a loan in such a manner without penalty. As you can see here on slide 12, our customers value our service and use it responsibly. According to internal surveys of our customers, 96% rate their experience as good to excellent. 97% of our customers repay their loans. This indicates that they understand and accept our terms and our service works for them, even in difficult times. Beyond our dedication to providing consumers with cost-competitive, reliable, and transparent credit, Advance America has a steadfast commitment to regulatory compliance and operates within a complicated framework of both federal and state regulations governing nearly every aspect of our business. We also believe that similar products, whether they're offered by a depository institution such as a bank or a credit union, or a non-depository institution such as Advance America, should be regulated by the same standards so that all lenders operate on a level playing field and consumers are protected and empowered in their financial decision-making. In our conversations with the Consumer Financial Protection Bureau and Director Richard Cordray, as well as with numerous officials at every level of government, we emphasize the need to shine a light on the practices of illegal, unregulated lenders. This is an issue that deserves more attention and further discussion. Many of these lenders operate primarily online, flouting state and federal law. They offer none of the consumer protections afforded by regulated lenders such as Advance America. In fact, they often exploit consumers, from repeated withdrawals from borrowers' bank accounts to scams that are designed to coerce payments from consumers who never actually took out a loan. Unfortunately, an unintended consequence of state regulations that overly restrict access to regulated storefront payday lending is that consumers turn to these risky, illegal lenders. In fact, according to an Urban Trust study for the Department of Treasury last year, a ban on regulated payday lending credit only resulted in a 35% reduction in use, with customers often turning to the illegal internet option. While Pew's recent studies question the impact of online lending, particularly in those states with restrictive regulations, industry analyst Stevens Inc. reports that the online lending market is a source of rapid growth, currently representing about 32% of the total industry in terms of volume, up dramatically from just a few short years ago. This is something we have experienced in our business, and it's something undoubtedly you've noticed in the constant stream of advertising both online and on television. Slide 16 highlights the fact that a number of studies have found that states including Oregon, Washington, Georgia, and North Carolina have reported significant increases in complaints against online lenders after restricting access to storefront payday lending. as well as other concerning consequences such as increased bankruptcies. As we continue to discuss consumer lending and options like payday loans, we need to acknowledge and differentiate between the good and the bad actors and be ever mindful of the unintended consequences of blocking access. Such restrictions do not address consumers' need for credit, as they seldom provide new, cost-effective credit solutions to Americans' financial troubles. The most expensive credit is often the credit that is not readily available. At the end of the day, there's a place for a regulated short-term credit, and in today's economy, consumers need it more than ever. Advance America and CFSA welcomes all opportunities to work with legislators, regulators, and consumer advocacy groups to help address illegal lenders and explore policies that ensure lawful lenders operate in a fairly regulated, competitive, and innovative marketplace, providing important and needed access to short-term credit, while also offering meaningful protections for consumers. Heather, thanks again to you and NCSL for highlighting this topic for your membership and for allowing me to participate in such a meaningful discussion.
Thank you, Mr. Fulmer. Now that we've heard from the distinguished panelists, we are happy to take your questions. Again, to ask a question, please type your question in the Q&A box that's in the bottom right-hand corner of your screen. As we are waiting for your questions, I want to let you know that this webinar is being recorded and will be archived on the NCSL website. So we do have one question so far, and we're going to open it up to all of the panelists. And the first question is it appropriate to use an APR, an annual percentage rate, when describing the interest and fees that are charged to consumers? If we'll have Nick, if you could take this question first.
Sure. APR is intended to be a comparison rate, and so the key purpose of an APR is so when somebody asks, hey, is this loan more expensive than that other loan, they can answer it. So I often ask people, is a credit card a more or a less expensive way to borrow money than a payday loan, for example? And people almost always say credit card. The way that people tend to know that is because of the APR comparison rate. It's an interesting question about whether it's appropriate to use APR, but the fact of the matter for a short-term loan, but the fact of the matter is that the payday loans are they're mid to long-term loans. So I think that tends to show that an APR makes sense there.
Okay. Jamie, how about your response?
Well, I think I demonstrated in our presentation how APR is calculated, and we think that it's fine to show an APR calculation in the context of helping consumers understand the cost of their loan and the true cost of their loan. But the problem is that all of the products that we compete most directly with, whether it's the overdraft protection products, the bounce check protection products, the late payment penalty fees to vendors, credit card companies, all of those don't carry the same APR calculation. So it gives our critics an opportunity to say 400% interest is wrong, but what they don't put in context is the cost of what happens if they don't have the payday loan option. And I think that's really where we need to drive the conversation so that consumers can understand fully and completely the true cost of what their options are.
Okay, and how about you, Professor Mann?
Well, I think I alluded to this in my slide. I think what you want to have from our perspective is lending products that consumers actually understand the costs. And so the APR disclosure of the Truth in Lending Act is a really good device for helping consumers compare different home mortgages that have the same term or different credit cards that are effectively lines of credit, but it's really not very useful for comparing across products, and especially, as Jamie suggests, for comparing to products to which it doesn't apply. And so I mentioned in my slides the two products I thought about were pawn shops and overdraft fees, and those are both things that if you try and come up with an annual percentage rate, they'd be much higher than payday loans, but they aren't usually disclosed that way. They're treated as non-lending transactions.
Okay, thank you. And Diane?
Yeah, APR is absolutely appropriate. It reflects the high cost, high risk nature of the payday loan product, and it's required by federal law to be disclosed in that terms and often required by state law as well. So I think it's appropriate and important for legislators to understand what will be coming into their districts to the extent a payday loan bill is authorized, and that is the advertisements that will appear in your constituents' neighborhoods. Second, in terms of the relation to overdraft fees and bounce check fees, I think it's important to remember that payday loans actually increase the likelihood that borrowers are going to experience those financial consequences of overdraft fees and bounce check fees. For example, national payday lending chains collect over millions of dollars, over $3 million a year in bounce check fees from their own customers. And that goes back to the inherent structure of the payday loan, which requires access to a borrower's bank account as a condition of the loan. Thus, when a borrower ultimately defaults, leading to both overdraft fees and bounce check fees, and as a Harvard business study found, increasing the likelihood that that borrower is going to be bounced out of the banking system altogether.
Thank you. We've got another question. How do state laws impact national banks that are offering payday loans or direct deposit loans or a similar product? How about we have Jamie answer this question first?
Well, I think most of the national banks that operate in the space do so under their charters and operate under federal law. So, I don't think they operate under the same regulatory regime in the context of offering these credit products that we do. I mean, we operate under specific state-based legislation that defines what the product is and how it's offered, as well as a whole host of federal laws that are now all encompassed under the Consumer Financial Protection Bureau. So, we believe, at least at Advance America, that the best regime is one in which it allows the states to have an influence on how the product is being offered to its consumers, but also where there's important safeguards at the federal level as well. And I think that works best for consumers in addition.
Okay. Thank you. Diane, do you want to respond to this one?
Well, to the extent that, for the most part, national banks are preempted from state laws, but state laws sets an important precedent for what is permissible and not permissible, or what is important in terms of public policy. And as I mentioned, states with strong state laws are deploying those as tools to prevent national banks from moving into this predatory arena in these states. So I think the activities of the national banks should not deter from states doing what it needs to do for consumers and protecting against these predatory practices, no matter who the actor is.
Okay, thank you. We actually have a follow-up question to the first one. The follow-up question is, why shouldn't overdraft and bounce check fees be disclosed as an APR similar to the payday loans? How about, Nick, would you like to take this first shot at this question?
Sure. One simple reason is that for various reasons, the federal banking regulators haven't considered overdraft to be credit, and so it does not apply. The credit disclosure rules don't apply to overdraft. That's sort of the technical reason. One item in the research that I'll point to is that, the vast majority of people who experience overdraft experience it as a mistake. So, for example, some of our colleagues at Pew have done research, nationally representative survey of overdraft users, and found that 90% of overdrafters said it was a mistake. So it's not something. Overdraft is not something that people tend to reach out for as a credit that they want. It's a mistake that they incur and a fee that they incur. So that may be one reason not to think of it as credit in that way.
Okay, thank you. And Professor Mann, would you like to try to have a response?
Really. I think it's, as a practical matter, difficult to set an interest rate on it, because once someone overdrafts, it's not a contract where you can be sure when they're going to pay it back. You can decide after the fact, okay, they borrowed $12 and they borrowed it for 17 days and paid a $40 fee, but it's difficult to apply the interest rate model to it. But I think the point that Jamie's making, and I don't think Nick disagrees with this, is that if you take the typical rate of time for which an overdraft is outstanding and assess the fee against it, it's really a very high interest rate. And I think that's typically the case, that it's an interest rate that's an order of magnitude higher than the typical payday loan. And I think Jamie's point is that's the product that people are competing against. And so if a customer looks at their statement and they say, okay, I need to get my car fixed and it's going to cost me $300, they could just simply write a check that would be an overdraft and pay a certain amount of fee. They can't borrow on a credit card by hypothesis because their credit card limit's reached. They can go to a payday lender instead of the overdraft because they think it's cheaper. I think that's the point he's making. The interest rate there is cheaper than on the overdraft, but as Nick says, people don't usually choose the overdraft because it's really the most expensive way to borrow money that you can imagine.
Oh, okay. Thank you very much. Unfortunately, we are almost out of time, so we are down to the last question. And this one I'm going to open up to all four panelists. And this question is, what is high risk about payday loans? And they ask to the to describe it in terms of the borrowers and also to the actual businesses. We'll start with Jamie, and we'll work our way back up.
Well, I think as I said in my slide presentation that any form of credit comes with inherent risks, and so I think that anything we can do to help consumers understand the choices they're making, I think that's certainly a good thing. I think what you have to balance that with, and I think Director Cordray said this at the Senate Banking Committee last week, that you have to make sure that you allow for a vibrant market to offer those forms of credit. You don't want to put in restrictive regulations that freezes up or constricts the credit in the marketplace. And so I think that's important for consumers. Now, in terms of the lender, when you look at our default rate, it's extremely low in terms of transactional volume. But if you consider the cost associated with that, it takes about 20% of our revenue right off the top before we've paid one employee, before we've paid one landlord, before we've paid our utility bill, any of our local or state municipal fees or taxes. And so all that has to bake into the cost of offering a product to consumers. And I think at the end of the day, if that is proper, and then the cost that you offer a product to consumers is acceptable to them in the context of their other options as well as the other features associated with that credit product, I think that's where you have the balance that provides for a viable market.
Thank you, Jamie. How about you, Diane?
Sure. What's high risk about the payday loan product for the borrower is the dangerous combination of terms that are codified into state law where they're allowed. This is the high fees combined with the quick due date, typically a borrower's next payday, combined with the fact that it requires access to a borrower's bank account, and that it's all due all at once. For borrowers who are already living on the financial edge, it shows over and over again that this leads to a long-term cycle of debt and eventually worse financial consequences such as overdraft fees, bounce check fees, bankruptcy, and delinquency on other bills. I think what's dangerous about the product is that it is marketed as one thing, a quick financial fix, but in reality it's not. It is not quick nor fixed. Ultimately, 50% of borrowers, this is not loan transactions, but borrowers, will default during their payday loan borrowing time, and they will do so only after paying hundreds of dollars in fees and interest to what started out as a small dollar loan. This is not a competitive market. There's no competition in price, and it actually deprives borrowers of future choices once they get stuck in this revolving door where their paycheck is immediately owed to the payday lender each payday. We think this is a high-risk product, and in terms of what it means to lenders, the FDIC has spoken to this, finding in 2005 that this bank's partnerships with payday lenders that led to long-term cycles of debt for borrowers was inappropriate and not good for the bank's financial position, and therefore recommended that a borrower who is in need of a short-term product should not have more than 6 in a 12-month period.
Thank you. How about you, Professor?
I guess what I would say is I don't think the question has really much relevance to payday lending because I don't think that it's proper to view this as a high-risk lending product. The interest rates, if you think of it as interest rates, are high, but that's because the dollar amounts of the loans are so small and there's just an irreducible amount of transaction costs involved in having a store and an employee. I'm not sure where Diane got the data to suggest that 50% of customers default. The data set I'm looking at, which has more than 50,000 borrowing customers and follows them for a course of more than a year shows a rate of default on a per customer basis of far less than 1%. I think it's absolutely clear that the number of customers that default on payday loans within a year is far less than the number that default on credit cards or mortgages. It's simply that when they default, the entire loan is likely to be lost, and the transaction cost of recovering it grossly exceeds the loan. And so that's why the fees, when viewed as a share of the loan, are high. But I don't think these are high-risk loans. I think they're relatively low risk.
Just to clarify on that last point, the default rates come from state-regulated database in Oklahoma, as well as a separate data set coming out of Texas of 144,000 borrowers in a study done by Vanderbilt and University of Pennsylvania researchers. Happy to circulate that to anyone who's interested.
Thank you. Thank you. How about you, Nick?
Yeah, Jamie pointed out that 97% of their loans are repaid, and I think that's an important number to keep in mind. I think what that number really indicates is that borrowers generally can afford the fee, one, and two, they want to repay their loans. So, the average fee on a storefront loan is $55. You see most payday loan borrowers able to afford that, and they will pay that fee over and over again to renew or extend or reborrow. What they can't afford in many cases is to actually pay off the loan. So, the risk comes in whether or not somebody's going to stop renewing their loan before they've paid off enough fees in order to to cover the cost and the principal of the loan. Apparently that's not happening today. For the borrowers, I think I agree with what the others said. The risk there is that the product isn't really being experienced in the way that it's packaged or the way that it's structured. For somebody going in thinking that they're getting a short-term loan or a 2-week loan and they're going to pay maybe $55 in fees, the average borrower is going to find that they have payday loan debt for 5 months and they pay $520 in fees. It's a pretty big difference, and that represents a lot of risk to people. A lot of other factors, there are a lot of indicators that payday lending does not eliminate the need to seek financial help elsewhere. So there are a lot of follow-on risks as well, overdraft fees and so on.
Can I just add that I think we tend to kind of sort of lead ourselves down this path that we have to look at products in a vacuum. And we have to look at them solely based on specifics of one particular product, and we ignore how they relate with all the other products and options that consumers have. And so, I think when you assess risk, when you assess costs, when you assess all the other features, you really have to take a global look. And I know Pew has done a lot of work on overdraft and bounce check protection and payday lending, but what's missing in the discussion is on linkage, so that we see how all these things stack up in the marketplace and interrelate with one another. And that's what we hear our customers say on a daily basis that is most important to them. So I think as we drive this discussion forward, we really need to take a look at that as well.
All right, thank you very much. This brings us to the conclusion of this webinar. For the questions we did not get to, we will collect the remaining questions and we will forward them to the speakers to see if we can get their response and forward them back to you. As a reminder, the full text of the report that was highlighted today is available on the web. And if you have any questions following this event, please feel free to contact NCSL staff. Our contact information is listed on the slide that's up now. Thank you very much for your interest and participation today.